Hi everyone, we're going to pick back up on the accounting slides with slide 8, other financial statements. Last class we talked about accounting in general. We went into discussing the balance sheet, the income statement, and the statement of cash flows. Make sure that you are familiar with the various components of the balance sheet and the income statement. The other statements that accountants often prepare and are looked at by those both internal and external to a firm include the statement of retained earnings and the stockholders' equity statement. These two statements show very similar things. They both talk about equity and retained earnings. However, they are slightly different. The statement of retained earnings shows how much of the income has been retained or kept within the organization as opposed to paid out in the form of dividends. This may sound familiar to you as this information is also on the balance sheet in the stockholders equity section at the bottom, where we talk about retained earnings and how much common stock we have. So the statement of retained earnings specifically shows how we got that retained earnings number. The general formula is we take our net income and then we subtract out the dividends that have been paid to our shareholders, and that leaves us with the income or the earnings that have been retained. So it shows us, we can look at that statement, and it shows us how retained earnings have changed from one accounting period to the next. And again, it is determined by subtracting the dividends paid to shareholders. Subtracting that from net income gives us the amount of retained earnings. The stockholders' equity statement again shows how net income and dividends affect retained earnings. However, it also goes into a little bit more detail and shows other changes in equity, like if the company would issue additional shares of stock or repurchase, buy back some of their own stock. So the stockholders' equity statement does give more detailed information specifically about the buying and issuing of common stock. So those are two other statements. We can additionally look at those notes to financial statements. This is the section that will give us additional information to clarify and supplement the main numbers that are already in the financial statements. We can look at maybe if the firm has changed its accounting methods, how it recognizes its revenue, or it's valuing its inventory. Again, for example, if they use the LIFO method as opposed to first in, first out, then they would explain that. Or if they were depreciating their assets in a different way. It includes maybe major changes that have occurred within the firm, if they have bought or sold additional entities, any risks that they are facing, any extenuating circumstances that are going on. Maybe if they had an unexpected loss, they would explain that in the notes of their financial statement. So we can often look there if we see a number that doesn't quite look right in the financials. We can look to the notes, and it's normally explained in that section. I mentioned in class comparative financial statements and horizontal analysis. Comparative financial statements, as we saw, that those statements list 2 or more years side by side, right, to really allow us to look and compare what's happened from one year to the next. The SEC does make it mandatory for these publicly traded companies to present comparative financial statements. That's why when we went on Yahoo Finance and we could look at those years side by side. many firms that aren't publicly traded also present comparative financial statements. It makes it easy for the stakeholders to do this horizontal analysis process, right? So horizontal analysis is simply just using comparative statements to identify changes over time. We saw in class it is very useful, and we can gain some insights about what's happened within that organization. The last type of statement or report is the independent auditor's report. All firms are required to have an audit. This must be included in the annual report sent to the SEC. So audits are mandatory. The auditors will come in and look at these financial statements and see if they are abiding by GAAP, if they are meeting the rules and regulations, if they are following the correct procedures. We think that, yes, an auditor may come in and just look at the statements and make sure the numbers add up, but they actually do a lot more. An audit is much more in depth than just simply checking those numbers, with the calculator. Oftentimes, auditors will interview the accountants and make sure that they actually understand the process that they went through and why they chose to use certain methods and procedures over others. They will possibly even talk to the CFO or those higher up in the organization. They may ask to get on your computer and into the actual computer system that you're using to keep track of your finances, to make sure that that system is working properly. They may even do a physical count, a floor count. They may, if you have inventory on hand, they may look at your inventory. They may ask to see certain documents and receipts. They may ask to see bank statements. So the audit is very in-depth and can be very complicated. Again, accountants will be interviewed and asked if they understand procedures, if they are following GAAP, if they and question possibly why they chose to use certain procedures over others. So the independent auditor will review all this information and then come back and give a report. So they will establish their written report and then give one of 3 opinions. So an independent auditor can give one of 3 types of opinions, either unqualified, qualified, or adverse opinion. So the unqualified is a good review, right? So we always want to have an unqualified review. If this is qualified, right, that means it was okay. There might have been some minor problems that we can go back and fix, but minor issues. But overall, the qualified opinion might mean that yes, these statements are fair and accurate, but there are a few things that need to be fixed. The adverse opinion, on the other hand, is major problems in the financial statements, and the auditor has found some very troubling findings there. So there's obvious cases of fraud or abuse, embezzlement, mismanagement. So the adverse opinion is the worst opinion you can receive. So again, that is the independent auditor's report, and those results are included in that annual report sent to the stockholders and filed with the SEC. And the opinion can either be unqualified, which means that yes, you did a good job with your financial statements, qualified if there were some minor issues, and then adverse if there were major problems. Moving on to budgeting. Budgeting is a process done by management accountants. It shows how a firm will acquire and allocate resources to achieve its goals. It looks forward into the next fiscal year, and budgeting will show what types of resources the company needs, how they're going to achieve their goals, how they're going to go about that, the processes, possible expenses, planned revenue, etc. So it facilitates planning and preparation for the year to come by requiring managers to translate those goals, so what they want to achieve, into actual measurable quantities. So exactly how many t-shirts does the company need to make in order to reach their revenue or their sales goals. And it allows them to identify the specific resources needed to achieve these goals. So how much inventory do we need? How much in salaries and wages are we going to need to pay to achieve that production goal? There are four main purposes to budgeting. First and foremost, it helps specify how the goals are going to be achieved. So budgeting allows managers to go into detail and really determine how they're going to go about achieving their goals. Because as we all know, we can set these arbitrary goals and we can have them out there, but unless we write down the steps and then work towards those on a daily basis, they're never going to be achieved. The second main goal of budgeting is it encourages coordination among managers and employees. This is very important because oftentimes there are goals set in the upper levels of an organization, and managers and top execs are aware of these goals and set them and try to work towards them, but they're never actually translated down to the employee level. So those working on the floor, actually working the production line, are unaware of these overarching goals. So budgeting really lets everyone in the organization work together. It encourages coordination and teamwork. The third purpose of budgeting is that it serves as a motivational tool. Right, so again, along with that coordination of managers and employees, it motivates everyone to work together, and it allows employees to see that vision and to understand what they're working towards, and then they can be motivated to meet the budget, right, and to meet the goals. The last purpose, number 4, it helps to evaluate progress and performance. Right, so it can be used. The budget can be used as a measure. Did we meet our sales goal? Did we stay within our expected expenditures? So it helps evaluate how far along we are, our progress, and our performance. So how well did those middle managers perform? Were they able to get their employees to meet the goals and stay within that budget? So those are the 4 main purposes of budgeting. And it can be, the budget process can be drawn up in one of 2 ways. You can see there on the slide we have top-down budgeting and bottom-up budgeting. So top-down is exactly what it sounds like there, right? So the budget is set at the top level. So your CEO, your CFO, your top accountants, they come together and prepare that budget with little or no input from anyone below, right? So the middle managers have no say in the budget, and the budget is set at the top. Bottom-up budgeting, though, is when middle managers do have a say. They participate actively in the creation of the budget in the budgeting process. Right? Middle managers work every day. Right? They understand what's going on the floor. They understand the production levels and the abilities of their employees. So they can have a say in what they feel is appropriate. Right? So we can see how, maybe there might be advantages and disadvantages to both of these approaches, right? Those who support the top-down budgeting say that, yes, top management should set the budget, right? They know the company's long-term goals. They are the ones that understand the strategic needs, so they are in a better place to make those budgeting decisions. They can see farther into the future, and they may have larger goals and are thinking about a bigger picture than just those middle managers who might only be concentrating on their division or their territory. So top-down budgeting keeps the control at the upper level, at the executive level, but some say that's a good thing. There's more financial control, more accountability for the top management staff. So top-down budgeting it might be the best way to go in some organizations. However, others argue that do the top executives really understand the needs of those working within the organization? Right? Do they really understand what employees are willing to do? Are they making completely inaccurate forecasts or demands, unrealistic demands of their employees? So while top-down budgeting allows top management more financial control, they may not be setting a realistic budget. But that's where the advantages of bottom-up budgeting could maybe come into play, right? Where middle managers can have a say and can give suggestions as to what their department needs and what the expectations should be, right? Middle managers are the ones that work with the employees and work on the floor on a daily basis, so they understand the needs and goals and the resources that their department may require. The bottom-up budgeting approach could help ensure that everyone's on board, right? When middle managers feel like they're a part of something, they can own that goal and that budget because they had a part in creating it. So it can increase employee morale and help make sure that everyone is on board and wants to meet those budget goals, right? So if you set something, if you help set the goal in the budget, you are a part of that process and it becomes personal to you and in your department. So you would be more willing to work hard to meet it. However, some of the disadvantages of this bottom-up approach, which you can see, is that if you have 5 or 6 different departments within your organization and all these managers trying to have a say in the budget, right, it takes time. A lot of people coming together and working to achieve this common goal. Everyone wants to have a say. Everyone wants their voice to be heard. Everyone thinks that their department is the most important. So getting all the middle managers to agree and then getting the executives to figure out how to put it all together and how to keep everyone happy can be very time consuming. Ultimately, someone may not have as much input as the other. The bottom-up approach can be good because middle managers know what's going on, but it can be bad because it could be very time-consuming. Another area of caution with the bottom-up budgeting is that budgetary slack can occur. Budgetary slack is the concept that those middle managers who are creating and saying what their department needs and wants, they may overstate the resources they may need. They may say, I really need this extra person, to come and work for our department to meet the goals, when in reality they didn't need that person. But having one more individual, one more employee working for them makes their job easier. So middle managers can alter their request a little bit in order to make their job easier, to lower expectations on their department. If they think their employees are capable of, producing 1,000 units a day, when in reality they could probably do 2,000 if they wanted to, the middle managers would only put in 1,000 because they want to make sure that they can meet or exceed all goals, so they won't be as hard on themselves. So middle managers can slack off, right, and underestimate their goals or overestimate their needed expenditures. So budgetary slack is something that we need to be aware of with that bottom-up approach. Okay, so those are the 2 different ways that the budget can be produced. So let's move on here to the next slide and take a look at the actual budget components. So slide 10 is a basic overview of a budget. The master budget is the entire overall plan of action. And it's broken down into operating budgets and financial budgets. If you would like a visual picture of the budget, you can turn to page 127 of your textbook. So 127 there, you can see the development of the master budget. The operating budgets are at the top, right, beginning with the sales budget. And the financial budgets occur later, right, after all the operating budgets have been produced. The financial budgets, the cash and capital budget, are produced. They're ending with the budgeted balance sheet. So the master budget represents the overall plan of action, broken down into the operating budget and the financial budgets. So the first operating budget that's produced is the sales budget, right? That's the first thing we need to figure out. How much do we think we're going to sell? What are our projected revenues, right? And then we can go into the production budget. So what do we need? What are our expenditures? Broken down into labor, materials, and overhead. And then what would be our selling and admin expenses, right? What are those back office expenses? So what do we need there in the production and selling and admin budget to meet our sales goals? Once those are done, we get down to our budgeted income statement, right? Remember our income statement. Income, our sales revenue, minus all those expenses, gives us our budgeted income statement. So then once we have our budgeted income statement, we can then produce our financial budgets. So we will look at our cash budget, our capital expenditures budget, then leading down into our budgeted balance sheet. The next few slides go into the operating budget and the financial budget in a little bit more detail, and I will pick up with those next class, and we will talk about those various components of the operating budget and financial budgets in more detail. Thanks everyone, and we'll see you next class.